Okay, Chapter 4, Job Costing. In this presentation, we'll review track the flow of costs in a job costing system, dispose of over and under allocated manufacturing overhead, and then understand variations from normal costing. Now, there's a JPEG there of an illustrated general ledger that you might want to either open up on your computer so that you can see it because it's too small in the presentation, or print it. Okay. You could probably just open it up and that would be fine. Now, the real work with this is tracking the flow of costs, okay, for job costing. All right, and this is where we are. We've got just these. This is where most of the calculations and the heavier concepts are in this chapter. And I wanted to review this just once more. This is the graphical representation of a job costing system, and the big thing is this indirect cost pool, okay, where all of your manufacturing overhead is. All right, and this is being allocated based on direct labor hours. So we've got an allocation base of 28,000 direct labor hours. So then we would take, which at $40 per hour, okay, so we would take the allocated manufacturing costs and the direct costs, and we'd allocate it to to the job. So the direct costs are coming up from the bottom and the allocated costs are coming down here from the top. Okay, so the direct are actual costs, okay, because they're traceable, they're easily traceable, but the manufacturing overhead is not traceable, not easily traceable, so it's allocated. And this is another cost flow one. That the upper section shows the flow of inventoriable costs from the purchase of materials and other manufacturing inputs to their conversion into work in process and finished goods, and then the eventual sale of goods, right? The lower section illustrates the flow of like marketing and customer service costs, other period costs. These costs do not create any asset on the balance sheet because they're not incurred to transform materials into finished product. Okay, the materials in the overhead, these are incurred just to transform materials into a finished product. So they're on the balance sheet, all right, even up to when that transformation is made, they're on the balance sheet until they're sold. Okay, whereas the period costs are never on the balance sheet, they're just here on the income statement. Okay, so let's take a look at the journal entries. And the accounting system in a company should reflect as closely as possible the actual state of the business. So this allows users of systems to view in the system a numeric representation of what's happening in the business. So manufacturing overhead that is allocated contains all manufacturing overhead costs assigned to jobs using a cost allocation base, because unlike direct materials used and direct labor incurred, overhead costs cannot be traced specifically to jobs in an economically feasible way, right? Okay? So the product costs are accumulated in direct materials, direct labor, and then allocated or applied factory overhead. So in journal entry 1, we purchased direct materials. All right, there's your purchase to materials, some control account, and then into accounts payable. In journal entry 2, we used direct and indirect materials, and notice that the direct materials are debited to the work in process account. So that's our direct material and direct labor. The indirect materials are part of overhead, so they're debited to the manufacturing overhead control account. Okay, so everything comes out of materials, but the direct go to work in process, the indirect go to manufacturing overhead control. In journal entry 3, shown here, this represents the effect of incurring payroll expenses for both direct and indirect labor. As with the material, the direct labor is debited to work in process, Okay, and the indirect labor is debited to manufacturing overhead control. All right, so direct can go right into work in process, but the indirect goes into the big overhead pot. Journal entry 4 provides an example of the entry of incurring or recording other manufacturing costs. In this case, we might have some supervisory salaries. Then it would be credited to cash control, but this could also be salaries payable. Utilities, repairs, insurance paid in cash, as if the purchases were made on account, and if the recording of plant depreciation. Okay, so these are all items that we can't trace to a unit of product. Okay, they're not easily traceable, so we have them, they go into the manufacturing overhead control and then get allocated per whatever the formula is, however we're allocating the overhead. What's this thing? In journal entry 5, it's recording the allocation of manufacturing overhead to jobs. Now remember, these are not actual overhead costs, but represent the allocation. And the allocation is calculated by taking the predetermined overhead rate times the actual base activity for the job. Okay? So the predetermined overhead rate, which is all based on estimates, but it's multiplied times actual activity. So keep in mind the distinction between transactions 4 and 5. In 4, actual overhead costs were incurred throughout the month and are debited to the manufacturing overhead control account. In transaction 5, manufacturing overhead costs are debited to individual jobs and to work in process control when manufacturing overhead costs are allocated. Okay? When we work on T accounts with this, to me that's what goes in my head a lot more clearly than trying to talk it through. But it's still good to review the entries so you know what's going on. On journal entry 6, we record the transfer of all individual jobs that are completed go into work in process control. So it comes out of into finished goods. It comes out of work in process and goes into finished goods. When goods are sold, there are two parts to the transaction. The first is a journal entry showing the reduction of finished goods control and the increase in cost of goods sold. This is the cost of goods sold side of the transaction. The sales and accounts receivable, where we increase revenue and increase accounts receivable, is shown in journal entry 9. Okay, it's coming up. Note that the sales transaction is its selling price, and the cost of goods sold is recorded at cost. All right, and that's how we get gross profit out of it. Here we've got various expenses that were incurred through the period. We might have marketing, customer service expense. Here they're coming out of cash. This could also be a payable. And here's our sale. So we've got a debit to accounts receivable and a credit to sale. Okay, and remember that the sales side is recorded at the selling price, and the cost of goods sold is recorded at cost. So when you look at an amount for sales or accounts receivable, this includes both profit and cost, right? Okay, this is the sheet that I thought you might want to look at something that you could read, all right, because this is pretty small. But in this diagram, this is a visual representation of what we've just recorded. And it's kind of handy to look at because I like T accounts. But here we've got materials control. There's our direct material. This is the, let's see, we're taking 85,000 out. And the 85,000, these are direct materials. They go right into 81,000 goes into work in process control. Okay, that's the direct material, and here's the indirect going into manufacturing overhead. Okay, here's 15 I think this is, no, it's 3. This is direct labor, 15,000, and then 4 is incurrence of other manufacturing department overhead of $75,000. So here's our total overhead. What we're going to do though is allocate based on a formula 80,000 of it. Okay, so this could actually be the same T account, all right? This 80,000 comes out, it increases work in process. So when you look at work in process, if you keep that cost of goods manufactured logic in your head, here's direct material, direct labor, and work in process. These are the costs added during the period. Okay, when goods are completed, they come out of work in process and go into finished goods. And when goods are sold, they come out of finished goods and go into cost of goods sold. So here's our revenue at 270, and there's cost of goods sold. Here's cost. The revenue is cost plus profit. And then we've got other expenses. Okay, so everything that we did in the journal entries is represented here. And this is, you know, I don't know, accounting books always have this stuff. I'm not so crazy about it. But this is like some kind of a material record. Here's a record by employee, and it just shows that whatever job they were working on is like credited for the job. Okay, so this would be the paperwork that would be underneath the transaction. Everything is done by computers now, so you know, I guess it's a mental representation. So this would be a subledger, okay, that contains the underlying data that helps managers keep track of a particular job. Okay, it shows this one, that the panel C, this shows the details of different categories of overhead costs, such as indirect materials, indirect manufacturing labor, supervision and engineering, plant insurance, utilities, plant depreciation. Okay. And the fact is, you don't realize it so much when you're in school, but when you look at the balance sheet, every account on the balance sheet has a subledger underneath it. Every one has something that goes along with justifying that detail. Okay. Whoops. Now recall that two different overhead accounts are used for our journal entries for overhead related transactions. We used a manufacturing overhead control for the actual, okay, actual overhead controlled, and then manufacturing overhead allocated for the estimated overhead applied to production through the work in process account. Okay, I'm going to have to remind myself of this because I use one T account, and I use the actual is on the debit side and the allocation's a credit. So I'm not sure why we have to use two, but I guess that's what they want to do. Now, under normal costing, a company's actual overhead costs incurred each month are not likely to equal its budgeted overhead costs allocated each month. Okay, they should be not crazy far apart, but they won't be the same. So the difference is identified as an over or under allocated overhead. So if the actual is greater than the allocation, it's under allocated, right? If the actual is less than the allocation, okay, then it's over allocated. So just think of it simply and take your time so that you don't transpose it. Underallocated indirect costs occur when the allocated amount of the indirect cost is less than the actual. So overallocated indirect costs occur when the allocated amount of indirect costs in an accounting period is greater than the actual, okay? And we've got three different ways to adjust it. We can use adjusted allocation rate approach, we can prorate it, or we can just write it off. You know, my preference is the simplest of all three, as long as it doesn't make any difference in anyone's decision making. Okay, so as you can see, we've got three methods here. The adjusted allocation rate approach, all allocations are recalculated with the actual exact allocation rate. So the adoption of computerized accounting systems has reduced the cost of using an adjusted allocation rate. Okay, a computer could just adjust it for you, but doing it yourself would be a real pain. A proration approach, the difference is allocated on a prorated basis between where the inventory is, okay? So it goes into cost of goods sold, work in process, and finished goods. Okay, based on relative sizes, which is pretty straightforward. You just make a ratio out of it. And under this approach, the cost can be allocated based on the amount of manufacturing overhead in each account, or on the basis of the allocated of the on the balances. Okay, or you could just write it off. You could just take the over/under allocation and adjust cost of goods sold. To me, that's the way to go. So several factors should be considered when choosing the approach, and there's a good chart in the textbook that summarizes this. The purpose of it, the total amount of the over/under allocation, whether the variance was over or under allocated. And materiality is probably the most important thing. If it's immaterial, then just get it out of the way. Okay? However, if you do it whoops, did I lose? Yeah. If you did it differently last month, then you should probably handle it the same way every month. Okay, and if your industry has a particular practice, then you should probably do it the way the industry does. Okay, and we're there. Just a little bit about the service sector. The job costing is just as appropriate in the service sector as it is in the manufacturing sector. Okay, if the actual direct labor costs are difficult to trace to jobs, those costs can be allocated using budgeted rates instead. Okay, the mechanics of using budgeted rates for direct costs are similar to the methods employed when using budgeted rates for indirect costs and normal costing. All right, it's just slightly different because it's not manufacturing, but it's really the same thing. Okay.